Welcome to Value Vest Daily, where we analyze the best value and momentum investment opportunities. Today, we are looking at a stock that just had an absolutely explosive move. We're talking about Ouster, symbol OUST. And the big question on everyone's mind is this Lidar powerhouse about to rocket toward $50 a share, or is it headed for a crash landing? Let's dive in. So to really get what's going on here, you have to understand the core idea, which is actually pretty simple, but, well, it's incredibly powerful. Ouster isn't just some random tech company. They are quite literally building the eyes for the next generation of artificial intelligence, the AI that's going to live and work in the real world with us. And that brings us to our first section, the physical AI revolution. We're going to break down exactly what Ouster does, and more importantly, why it matters so much right now. Okay, so what in the world is physical AI? Look, forget about the chatbots you've been hearing about. We're not talking about AI that just writes an email. This is about giving real machines, think robots, autonomous trucks, you name it, the ability to see and understand the world around them in 3 dimensions. And Ouster's high-resolution LiDAR sensors, well, they're the hardware that makes it all possible. Now, this gets us to the company's moat, its big competitive advantage. Here's the deal. Once a customer designs an Ouster sensor into their product, whether it's a forklift or a security system, it is super difficult and really expensive to rip it out and switch to a competitor. That stickiness, that's the magic. It creates a really stable, long-term business. Okay, a strong moat is one thing, but you've got to ask, are they making any money? That leads us right into Ouster's fundamental strength. And let me tell you, the numbers are starting to look very interesting. First off, get this. A record $35 million in revenue for the second quarter. This wasn't just a decent quarter, it was the best quarter in the company's history, a huge beat. And that record number isn't some flash in the pan, it represents a 30% jump from the same time last year. That kind of growth tells you that demand for their technology is not just strong, it's accelerating. But it's not just about selling more stuff. It's about making more money on everything you sell. Their gross margin has now expanded to 45%. That is a fantastic sign. It means they're becoming more efficient, and they have pricing power. They're keeping more of every single dollar that comes in the door. Now listen up, because this might be the most exciting number on the screen. A 50%, that's 50, year-over-year increase in their recurring software subscriptions. This is huge. It shows they're moving from just selling hardware one time to a sticky, high-margin subscription business. And Wall Street absolutely loves to see that. So when you put it all together in a table, the story becomes really clear. Just look at that revenue line. It's projected to keep growing over 30% a year. Now, yeah, look at the EPS, the earnings per share. It's still negative. But notice the trend? The losses are shrinking. This is the classic playbook for a high-growth company finally hitting its stride and marching toward profitability. So what's lighting the fuse right now? Well, it's kind of the perfect storm. They just announced a big partnership with a major security firm, Constellus. Analysts are upgrading the stock left and right. And maybe biggest of all, it was just added to the Russell Index, which basically forces big investment funds to go out and buy the shares. That's some serious buying pressure. And hey, you're going to want to mark this one down. The next earnings call is November 4th. This is going to be a massive day. A real test to see if they can keep this incredible momentum going. So, okay, the fundamentals, they're looking pretty darn good, but what about the timing? Is now the right time to get in? That brings us to our next section. Let's decode the technical chart and see what the price is telling us. And this is the million-dollar question, right? The story is compelling, the numbers are great, but have we already missed the big move? Has the ship sailed, or is there still an opportunity here? Let's take a look. When we look at the chart, it's actually giving us a pretty clear roadmap. We've got a solid floor of support down around $31.50. That's a price where buyers have shown up again and again. Then looking up, there is a ceiling, resistance, right around that $35 mark. If the stock can decisively break through that $35 ceiling, well, that could be the signal for the next big run-up. And what's really compelling from a technical standpoint is the RSI, the Relative Strength Index. It's sitting right around 47, which is basically neutral territory. In plain English, that means the stock isn't overbought yet, even after this big pop. There's still plenty of gas left in the tank, technically speaking. All right, so we've got strong fundamentals and we've got a chart that looks poised for more. So where could this thing actually be headed? In our final section, let's look at the future outlook and what the analysts are saying. One of the biggest votes of confidence you can get is from what we call the smart money. And as you can see, almost half the company, 48%, is owned by big institutions. These are the giant funds with huge research departments. The fact that they own so much is a massive signal that they believe in the long-term story here.
So what does Wall Street think? Well, over the next year, the average analyst price target is just shy of $36. That's a pretty healthy potential return from here. And you have to remember, some of the more bullish analysts are calling for prices as high as $50.
But let's zoom out a little bit. If Ouster can keep growing at this clip, say around 35% a year, a 3-year price target of $70 suddenly comes into view. Yeah, 70. That's more than a double from where we are today, which really shows you the kind of long-term potential we could be talking about if they execute. Of course, let's be real. No investment is a sure thing. We have to be balanced. The company is still losing money. The whole Lidar market could take longer to develop than people hope. And they've got some fierce competition out there from folks like Innovis. And with a high valuation like this, any little slip-up could cause the stock to take a pretty big hit.
And that leads me to our very important reminder. Nothing you've heard here is financial advice. This is all just for informational and educational purposes. You've always got to do your own homework before you make any investment decisions.
So there you have it. The fundamentals are pointing up, the momentum is strong, but the risks are definitely there. That next earnings call on November 4th is going to be absolutely critical. Please subscribe, like, and share ValueVest Daily for learning daily opportunities before you put your money to work. Thanks for watching.